Bank of England say we are in a recession as interest rates get risen again to 2.5%, a 14-year high, and apparently it's the Queen's fault. So what does this mean for us as property investors? In this video, we're going to discuss what this means for us and also what we should be and can be doing as property investors to protect ourselves against this market changes. Warren Buffett says time in the market will always beat time in the market. So I'm going to share with you at the end how you can structure a portfolio so you can stay time in the market. But the best way to stay in the market at this right moment is hitting that like button. Really, well, maybe it don't help you stay in the market, but it really helps my ego. So let's get into this interest rate rise and discuss what the effects it's going to have on us as property investors. So the headline come from The Guardian. There's a major headline which said Bank of England says UK in recession as interest rates hit 14-year high at 2.5%. But then it goes on to say that the UK central banks predict economic shrunk for the second quarter in a row after shops closed and many stay at home for the Queen Elizabeth II state funeral. So that was my bit about blaming the Queen. One day, will that majorly shrink it? It feels like they're always pointing fingers towards somewhere, but obviously that would have had an impact on the economy as a whole, and that might have been the tipper to shrink that down. But in my opinion, I think it was shrunk regardless if we had a day off for the state funeral. Is this going to spark a massive recession? I've done a video here about a 70-year decline in the market, showing the history, 174 years of the history of the UK property market. So it might be worth having a watch of that, because I'm not going to go too much in depth on that. But we're pretty much in a recession now. How long it's going to last, none of us know for certain. None of us have got a crystal ball. It's only predictions. You can only use the past as a bit of an indicator, not as a guarantee of the future. And that's what I discussed in that video. So have a look at that video. If you want to carry on watching now, the video will be in the suggestion in the description below as well, so you can carry on watching. But what effects is this going to have for us as property investors? So look, The Guardian, the Independent, have put in the biggest hike in 14 years to add £600 to some mortgages per year. So that's quite a jump, especially when we've got all the other cost of living things going on. Again, not going to talk too much about the other stuff on cost of living, because I did do a video on that also, which you can watch later on, or jump to that now. But look, they've also said some homeowners could see annual mortgages cost increase by around £600 as a result of the interest rate rise. UK Finance said mortgage borrowers who deal direct tracker, so if you're on a tracker base rate, track the base rate, will see payments increase by around £49 per month. And this is all added pressure into it. Zoopla, which gathers a lot of data, big platform, said 150,000 people with a tracker mortgage and around 1.1 million on their lenders' standard variable rates will be affected. So it's quite a lot of people, around the 2 million mark of people is going to be affected. Zoopla also go on to say, our research found that an increase from 2% to a 4% one means that the average first-time buyer will need an additional £12,250 a year income for payments to remain affordable. So this is obviously recipe for having an effect on house price growth. And the main reason we're doing this is because of the running away inflation. What are the government going to do about this? We've got obviously a new Prime Minister. I've done a video on Liz Truss here and some of her policies, but one of her first major moves has been to announce a cut. So this is in the Telegraph, by the way. How cutting stamp duty could solve the nation's crisis. And I'm not too sure about how it can solve the crisis, but it will potentially help. But is it far enough cutting the stamp duty? Because they're going to announce that today. I'm recording this today, so by the time you watch this, you might already see that it's already been cut. But that is one of their moves to try and help that. Another move to try and help it has been the energy price cuts, and this has definitely slowed inflation down. Inflation has shrunk from 10.1% to 9.9% because of fuel come down mainly, and they was predicting it was going to be around 13% in October. Now they're saying it is not hit its peak yet, but it's not going to go so high now there's been a reduction on fuel. The thing is, the monetary policies behind trying to get a handle of inflation is putting interest rates up, but there's other inflationary factors going on in the world at the moment. Namely, is that a way how you say that? But majorly the conflict that's going on in Europe at the moment, in Ukraine, is having a massive effect on inflation. There was massive inflation effects before that. We had COVID, we had money printing, we've had money printing since the 08 crash, we've had low interest rates. When you've got low interest rate and cheap money, that pushes assets prices up, that pushes spending up, and that pushes inflation up. That's a result of doing that. So there's loads of economic factors gone on with that, but then there's a major one with this war going on alongside that. So raising interest rates, will that majorly have an impact on that? I'm not sure. But is Liz the right person in place to start dealing with this? There's going to be some tough decisions. She's already saying she don't mind being unpopular. So he said, the new Chancellor Kwantang said, if I pronounced that correctly, said taxing our way out of prosperity has never worked. To raise living standards for all, we need to be unapologetic about growth of economic. Cutting taxes is critical to this, and whether business reinvested fed upwards in cash, so bottom up incentivifications by lowering taxes, is mainly their approach of what they'll be going after with this. And they're saying about they're reversing some of the things like the national insurance going up, the corporation tax going up. They're talking about lowering taxes to incentivize businesses to grow. I think that's probably a good idea, but who knows? Only time will play out to see if whether or not they will follow through with that, or whether it's just big talk at the moment. But the most important thing you want to be doing as a property investor at the moment is making sure you protect yourself in the market. There's a number of ways you protect yourself with this. High cash flow, low yielding properties is the way forward that's going to give you protection. Having a high yield, I've done a video on yields here, so I'm not going to explain too much on that here. So having a high yield is what gives you that buffer when interest rates go up. High cash flow doesn't do that. Also, solid family style homes that could be protected by the downside. You've got to protect the downside in this. So say, for instance, somebody loses their job and they go on to benefits because job cuts and recession hits hard. If somebody goes on for benefits, you want to know that can be covered. And homes in and around the north, that's why I'm a remote property investor. The properties I buy can be covered by housing benefits. You want to learn how to find them style properties, make sure you watch this video because it'll go more depth on me and my area, the style properties I buy, and the property all-weather portfolio wealth building strategy that I talk about in that. The property delta matrix will really help you navigate through this. As I said, I won't go in depth now because it make this video too long. But if you want to understand that, definitely ever watch that video. The one thing you've got to remember is more millionaires get made in a recession than any other time. There's a massive wealth transfer. So I've done a video on a wealth transfer. I believe there's a massive one going on property at the moment from the south to the north. There's a fact in that video there if you want to watch that as well. But you want to educate yourself. You want to position yourself correctly and do not miss this. See this as an opportunity, not as a negative time. But you've got to position yourself for the downside and make sure you don't get wiped out. So if you want to learn even more about that and go deep dive on a workshop, I'm running a workshop on Thursday. If you're watching this beyond that workshop, make sure you still click that link because you can register for a future one coming up. It is bit.ly/invest remotely. I teach you how to find the right areas, how to build this all-weather portfolio, teach you how to find the deals, fund the deals, and then manage the deals from anywhere, wherever you are in the country, or whether you're in the right, like living in a city where these fundamentals works. This works for startups or scale-ups. So join me on that workshop. It's bit.ly/invest remotely. The link will be in the description. But listen, my wife's living my terms. My mission is to help as many people live on their terms. So please hit that subscribe button, hit the bell icon so you get notified every time we do videos like this. Give a massive hit of the thumbs up. I don't know where I was going with massive, but hit the thumbs up. Really helps the algorithms out. Please share it to somebody if you think they will get value from this. And remember, if you don't evolve your ideas, you never live on your own terms. So evolve your ideas, live on your own terms, have an amazing day. Don't forget to watch the video that YouTube is suggesting you watch now as well.